Hey everyone, it's Henry. If you're new, I'm an option trader who's 9 years of experience into his trading career, and I'm going to say something unusual in this video. I can't believe I'm actually going to say this, but now is a good time to buy a long straddle on the market. And I'm going to explain how that works, why it's the first time ever and that I'm recommending this. And lastly, I'm going to open up this position myself right before your eyes. So it's going to be a very exciting video. Make sure that you stick through the whole thing. I know so many people out there are trying to grow their small portfolios and some just want to take a big risk to 10x their portfolio. Well, of all of the strategies, buying a long straddle is definitely on the higher risk side, but if done right and the market does what I think it's going to do, then you're going to see some stupid gains. And I'm going to show you the secret indicator that I use that's not on Robinhood, which you can see right now. So check this out. I like using TD Ameritrade sometimes. I don't have a whole lot of money with them. However, there's a really important indicator that I like to look at. And that's when I go to the trade tab right here, I will type a stock. So for example, I just put in ticker symbol TSLA, and then I go down to today's option statistics. And what I'm currently looking at is the current IV percentile. This stands for the current implied volatility percentile. So what 28 means and why this is absolutely pretty much game changing and why I think buying straddles right now on Tesla, along with a lot of other stocks that I'm going to check out right before you, is going to be a very interesting thing. And I think it's going to be very profitable. So let's talk about what 28% means. For example, I'm going to relate this to height. If you are a man and you're 5'3", you're going to be about probably 20 percentile or 10 percentile. You're not going to be very high up on the percentile because you're a little bit shorter than average. I think the average height in US is about 5'9", maybe 5'10". If you are 5'9", 5'10", the average IV percentile for you would be about 50. If you're 6'3", it's going to be about 90. So given that a higher IV percentile means that there is more volatility, 28 means that there's significantly less than average volatility, which to me makes no sense given the market right now. The market is pretty much crazy. It's going up, it's going down. We just saw a 3% move downward after, the Fed meeting, after other meetings that we have in our macro economy. The market's just falling and Jay Powell's kind of nuts out there, right? And that means there's a lot of volatility, but the current IV percentile makes no sense. It's 28 for Tesla. For example, if I put in Google, GOOG, okay, alphabet stock, and I look at the option chain, and I go to option statistics, it's about average, 52%. Again, that kind of seems okay. However, the market isn't okay. It's moving up and down and people are panicking, and I don't think that it's about average. I think it's way above average. Now, let's take a look at NIO. NIO currently has an IV percentile of 14. That means basically 86% of the time, NIO is more volatile than it is right now. It really can't get less volatile because it's at 14. How much less volatile can it get? So given these circumstances of NIO, Tesla, Google, and I'm pretty sure the rest of the market is about average or below average in implied volatility. However, if I pull up the market, it's pretty much going nuts. So taking a look at Tesla, in just the past 6 months, the stock was $381 per share post-split, and then it went down a whopping 45%. 45%, there's so much opportunity in option trading right now. 45% is insane. Then from 45% down, it has picked up about 47% up, and now it's pretty much in the middle. But this doesn't make sense to me. The stock is going up a lot and then down a lot and up again, and now it's just going sideways, and I think something big is going to happen. I mean, it's impossible to say that, hey, tomorrow something big is going to happen. However, the implied volatility is not pricing in what is possible to happen. And what's possible to happen is the stock could shoot up back to these peaks right here, about $380 per share, or maybe the market starts selling off and this stock can go down to like $220 per share or $209 per share. So this stock has a potential really, really big move. However, the implied volatility is not pricing that in, which is why on Robinhood, I do want to show you something called the long straddle. I'm going to be discussing reasons why it's time to buy a straddle as I just showed you, and actually 2 different plays that I'm going to be showing you examples of. You're really going to like what I have for you. But I just want to let you know, I really appreciate it when you smash that like button for me. It really makes me happy. And also check out my description for the live 1-day put selling event and my upgraded Discord live trading group. I'd love to coach you and show you all my trades that I'm making. So what exactly is a long straddle? I've talked about it for a couple minutes now. A long straddle consists of one long call option and one long put option. Imagine this, Apple stock at $100 per share. It's about to report exactly how many iPhones they have sold, and investors are anxiously awaiting. This is a big quarter because Apple went from 3 cameras, let's say, to like 5 cameras on the back. Like, you know that meme, right? Well, because this event for Apple is going to cause a monster move, a long straddle is perfect. We don't know if the iPhone is going to be taken positively by the public or not. We just know that either people will love it or they will hate it. So this earnings on Apple is going to be a huge turning point in the company for better or worse. Some investors will buy calls thinking Apple will rise. While they may be right, their chances are basically a 50% coin flip. The stock will either rise or fall. Nobody actually knows. Many other investors will buy put options. They will also be in the same position. They have a coin flip chance to make money. But here's what a smart option trader can do to make money more likely than either of the previous two people. He can buy a call and a put at the same time. This is called a long straddle. So let's go over a specific example right now. I'm gonna go TSLA or TESLA for Tesla. I'm gonna pull up Tesla right now on Robinhood. And I'm gonna go to trade Tesla options. I already have a couple positions. As you can see, I'm up a total of $404. Really awesome. I am selling options on Tesla and that is going really well. However, now I do think there's going to be a large move. Again, Tesla's implied volatility right now is way below average, yet the stock is kind of in the middle, right? It's not high, it's not low, and something is going to break or something's going to rise. It's going to go one way or another. Sure, it could stay the same, but I really don't think that's going to happen with all the volatility in the market right now and the big disconnect with Tesla's implied volatility from the TD Ameritrade screen that I showed you. So what I'm going to do, of course, I don't know if this is going to play out in a week. Therefore, I'm going to buy a long straddle out until the holidays, because during the holiday times, people are having a good time. They're either going to be really bullish, or during the holidays, your wife spends all your money and you don't have much, so you have to sell all your stock. So let's go into the first thing that I'm going to do is December 16th is the date that I'm picking, okay? I'm going to scroll down to the current price of the stock, which is around $303 per share. Now, here is what a long straddle is. Again, it's buying a call option. So I'm going to buy the 305 right here, which is right at the money, right? It's right a little bit higher than the current stock price. And then I'm going to go buy a put option because again, I don't know which direction Tesla is going to go, but I think that it's going to move really big in one way or the other, either to the upside with a call option or to the downside with a put option. So I'm going to buy the 305 strike right here, put option. So after I do this is a fairly expensive position. Again, it's on Tesla. I'm going to show you a different position on pounds here, which is going to be pennies. It's going to be like, 30, 40, 50 bucks. It's going to be really, really cheap. But with Tesla, just for example, this is still an interesting position. Although it is fairly expensive, your maximum profit is unlimited. The sweet spot for this stock is to shoot up to the moon, to go absolutely astronomical. Elon Musk says, hey, we're going to make FSD available and all kinds of good stuff. The robot is making some money now. We're going to monetize on the insurance business. We're going to make everything monetizable right this second. And boom, Tesla's going to shoot up to the moon, right? Or it's going to go straight down to the toilet. Let's say there's some other allegations about Elon Musk doing something bad, or Tesla has a really bad earnings quarter, whatever. It goes straight down to the toilet because of volatility, or Jay Powell raises interest rates by another 300 basis points, which the market completely does not expect. Therefore, the stock will go down to the toilet. So that is the sweet spot. You really want this stock to shoot up to the moon, and at $373 per share, you would start making money on the upside, unlimited, all the way up to, as high as the stock goes. Or on the downside, if the stock falls below 236, again, I said that the stock could be, $200 per share. So you can go down to like $200 or so. At that point, you would also start making money in this sweet spot zone. Now, theoretically, the maximum profit here is unlimited to the upside. You do basically own a call option, so you can make as much money as the stock rises. Now, if the stock does go down, potential profit may be substantial, but it is limited to the price minus the net debit paid. But it is limited to the stock just going down to zero. Now, in terms of maximum loss, the potential losses are limited to the net debit paid. So whatever you paid for this position is the maximum that you could lose. And as time goes by for this strategy, time decay is actually not that good of a thing. Now, typically as an option seller, this is what I teach in my Discord community. We're selling options on a weekly basis and collecting, a few $100s to a few $1,000s a week. But for this position right here, actually time decay and theta is not a good thing. It's kind of like a mortal enemy. As time goes by, your options are becoming less expensive and they're becoming less valuable. Therefore, your position will lose value as time goes on. So your hope is something does happen. However, you do have until December 16, and you can actually close this position early. So you do not have to open this position and then wait until it expires on December 16. In fact, over the next 30 days or 60 days, if good things happen, you can sell this position for a profit. You can take your profits and just reinvest them in something else as you wish, as long as the stock is up a lot or down a lot in a certain period of time. It actually does not have to reach this break-even point of $373 per share. Let me give you an example. Say that the stock is up about $50 in the next week, right? So it will go from about $303 to about $350 57. Well, although it's not in the sweet spot zone yet, actually, because this option position moves so much in a short amount of time, I wouldn't be surprised if you could turn $6,000 into about $12,000 or $18,000. You would actually be able to 2 to 3x your position in a very short amount of time if you have seen a big move like that. Now, I do want to show you a cheaper straddle because this is expensive on Tesla. So I want to pull up a different stock such as NIO or Palantir. Let's pull up NIO. It's much more affordable. And I also know a lot of people have NIO stock and maybe the stock hasn't really done too much. Me personally, I've been selling put options and covered calls. In the past 3 months, this stock has meagerly moved up about 2.83%. I'm up about 8.5%. So about a 3x gain from what NIO stock did using options. But let's look at a straddle. Let's say you don't have NIO or you do have NIO and you think that the stock is either going to shoot up, or let's say that China goes kind of nuts and, delists or bans or whatever, something really, really bad happens. Well, a straddle again is going to play on the really good stuff potentially happening or the really bad stuff that's going to potentially happen. So either way, you're pretty hedged on one way or the other, but you do need a really big move to happen. You're basically betting that implied volatility is going to increase. And that is actually a really good bet because if you remember in the beginning of the video, I showed you that NIO's current implied volatility is 14. It's literally 14%. And that means that even if NIO doesn't go up a lot, or doesn't go down a lot, but implied volatility increases, this position is going to increase significantly. And actually, I'm going to show you exactly how much it can increase. So first of all, let's go to buy. So I'm going to buy this $20 call option right here. So this is a bullish bet. Now, actually, if you take a look, the Vega here is actually what implied volatility is. So when implied volatility increases by 1%, your option position right here is going to increase by about $3.90. So if NIO became 10% more volatile, then this position right here would increase by $39. That's a really big move. And although the implied volatility right now is 71%, which may seem high, again, on TD Ameritrade, I saw that the IV percentile was only 14. So NIO stock and options could absolutely not be at 71. It could be at 81 or 91 or 101. And I have seen that many times in the past. So the implied volatility can rise significantly, which right here, Vega tracks, and this option would become significantly more pricey. So imagine this, the stock doesn't even move anywhere, but the stock goes up by $3 and then down by $3 and it stays at $20. However, investors realize like, whoa, this stock is more volatile than I thought. And the market starts pricing in more potential implied volatility, which is very, very likely. Then this option position won't be $3. Maybe it'll be $4 or $5 or $6. Therefore, your option right here, the call option that you were buying for 20 is going to double in price. Now, let me go ahead and also buy a put option. So now I'm going to buy a put option also at $20. This put option right here is going for $268. The implied volatility is very similar and the Vega is very similar as well. Now, this maximum loss is only $561, way more affordable. Again, don't open up your entire portfolio of this, but definitely there is a place for this position right here. And this is exactly the position that I'm going to open up when the markets open this morning in the next couple of hours. So the break even here for NIO is about $25 per share on the upside. And then on the downside, it's about $14.39. However, this is how I'd actually play this position. I wouldn't actually hold it until December 16. What I would do is I would currently play on implied volatility increasing and going back to about average. So since NIO's at the 14th percentile, I think it's going to go up to maybe 30 or 40 or more likely 50. And what's going to happen is even if this stock stays the same, even if it stays at $20 per share, if implied volatility rises, then Vega is going to increase the value of these options, both for the calls and puts. So essentially, NIO can stay at $20 per share. And I still think that these options are both going to become more valuable in the upcoming weeks. And when they become more valuable, I'm just going to sell off this long straddle, sell it for a profit. If you want to see me open up this trade, or if you just want to see a live training with me on a one-day event, then go ahead and check out my description. I've never done an event before, and I think this might be my first and last event. Registration does close in less than 2 weeks, so make sure you check it out. It's not expensive. It's a one-day event where I can meet you and teach you everything that I know about selling put options and also selling put credit spreads so you can grow your portfolio consistently, even if it's small, without taking that much risk. Thanks for watching, and I'll see you in the next one.